Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, in focus here this week as far as 3Q earnings are concerned, retailers. They reported this week. Some reported, some are yet to report as we tape this. On the aggregate level, what do you think that group is going to look like? Those fall largely into consumer discretionary, right?
Largely into consumer discretionary. I don't have the retailers specifically broken out, but if you look at the revisions indexes for this year, right now consumer discretionary is at the absolute bottom for this year and next to the bottom for next year. And I mean, the revisions ratio for this year is 0.17, so better than 5 cuts for every increase. For next year, it's down to 0.06. So you're talking close to, 20 cuts for every increase.
Yeah, so not a happy time.
That is not a happy time. And Christmas has been canceled for this year. I mean, not the religious part, but...
As far as the retailers are concerned?
Oh, yeah.
They've pretty much written it off, really?
They pretty much have to. I mean, because the consumer just isn't going to show up. You're already seeing major sales, the sort of sales that you don't normally see till right before Christmas, and every indication is that this is going to be a very bleak Christmas. I mean, this is Christmas controlled by the Grinch and Scrooge, not by Santa.
Okay. Let's take a look at the financials. Leading the news in the financial sector, again, your scorecard shows them doing the worst. No surprise there. But Amex has become a bank holding company now. So it effectively frees them up to take federal money.
Yeah, everybody wants to get in line to be a bank these days because the government is throwing money at the banks.
So is this going to make a difference to their earnings going forward?
It probably slows their long-term growth rate because with becoming a bank, you have to accept a lot more regulations, limits on leverage. For the short term, though, probably helps things a bit in terms of access to cheaper funds. Part of the problem is that their model really depends on being able to sell off credit card receivables in the form of bonds and stuff. That just simply isn't happening. So what are they going to do? The only alternative, if they can't get funding, is to start issuing fewer cards, cutting back on people's credit limits, stuff like that, which Amex has been doing, and the other banks, mostly go through MasterCard or Visa, have been actively doing that. They simply have no choice. Again, that feeds back to the consumer. If all of a sudden you thought you had a $10,000 limit on your card, and now it's $2,000, and
right.
You were carrying a balance of $1,800, Christmas shopping gets a little bit constrained. And obviously you can no longer tap home equity. The housing ATM is long since shut down.
Right. So maybe longer term, good news for Amex.
Well, longer term, I'd say it constrains them, but it makes them more stable. But I think everybody, I think everybody would love to be a bank holding company at this time.
Yeah, I've been looking into it myself.
Yeah.
All right, on the overall picture as far as earnings, companies largely posting disappointing results. We've known that for a while. Profit reports on the street show 3Q earnings going to be down 42% versus 3Q of 07. You agree with that?
Well, it depends on, if one includes all the write-offs and whatnot, yeah, that is pretty close to the figure one would expect. On just the operating earnings picture, it's not quite that bad. On a total net income so far reported, and we're getting towards the home stretch, we're actually only down 7.5% through the close on last Thursday. Now, since then, we've gotten some some pretty nasty news in terms of the GM and Ford earnings, which weren't included in these numbers. The AIG news of losing $25 billion or thereabouts, which will definitely filter into much lower numbers. Combining what we had before those numbers, the projections and the actuals, we're looking for down about 13.5% this year. But again,
year over year?
Year over year. But that excludes an awful lot of special one-time charges, write-offs of goodwill, things like that, which could easily bring it up to that sort of figure that you're talking about.
All right, let's look a little further out then, because people are always interested in the bigger picture further out. A lot of economists right now are expecting the S&P 500 earnings results to steadily deteriorate through the first half of 2009, recover weekly in the second half. Is that what you're seeing trend-wise?
Certainly in terms of it's looking at just the 2009 over 2008 numbers is a little tough because both are coming down. But if you peg it off of the 2007 numbers, which are obviously stable, you're seeing the forecasts come down at roughly a growth rate of 1% per day.
Well, here, let's put it this way.
Which is scary.
I've got forecasts of S&P year-to-year earnings growth for 2008 to drop 9% and come in a weak 14% for 2009.
Right now we're looking at 16.8% over the 2008 numbers, with the 2008 numbers being down about 8.5% from last year. But as I said, those numbers for 2009 are dropping at a rate of close to 1% per day. The same story, more or less, for the fourth quarter numbers. And I would argue it's not so much that we've had disappointing third quarter numbers, but the guidance for the fourth quarter in 2009 has been an absolute horror show.
Okay, where do the bright spots lie? Any? Going forward.
Healthcare is about the closest that we can find. They actually came in sort of overwhelmingly better than expected, about 6 positive surprises for every disappointment in that sector. Economically a pretty stable area, and that's the only sector where we're seeing more estimate increases than cuts for this year, just barely, a revisions ratio of 1.05. And it's the best sector for 2009, but even there, you're running more than 2 cuts for every increase. And that's the good news.
Okay. and let's leave it at that. That's the good news. Earnings Trends provides investors with an in-depth analysis of the markets along with the profit performance of S&P 500 companies. And each week this report identifies which S&P 500 sectors are showing strength and which are showing weakness. In addition, Dirk's weekly piece highlights the most attractive sectors based on valuation and projected earnings growth. Dirk's entire earnings commentary for this most current week, including his median growth and revisions tables, may be viewed online, accessed right off of the homepage at Zacks.com. You scroll down till you see Dirk's picture and the headline right next to it. You click on that link and it'll take you right to it. And I encourage you to read the text version of Dirk's weekly commentaries because he really details out a lot more than we have time for here in this piece, exactly what the numbers are saying. With Dirk Van Dyke, I'm Terry Ruffalo.